Welcome to the deep dive. We're here to cut through the noise, and today, well, we're diving into Intel.
That's right. A name everyone knows in computing.
Exactly. They just released their Q2 2025 financials, and let's just say some of the top line numbers might raise an eyebrow or two.
They certainly might. But as we always say, the real story isn't just the headline figure. It's always deeper.
This isn't just about dollars and cents, is it? It feels like we're watching a tech giant, really navigating a major strategic shift.
Absolutely. And for this deep dive, we're primarily using Intel's own words, their official press release. Intel reports second quarter 2025 financial results.
Okay.
Our goal here, for you listening, is to get past those raw figures. We want to understand the why. What's Intel actually doing right now?
Right. What are the strategic moves?
Exactly. And what does it all signal? For Intel's own future? Sure, but also for the semiconductor industry as a whole, and maybe even for how you think about these huge tech companies.
So we're aiming to pull out the really important insights, maybe some surprising facts that shed light on where Intel is heading.
That's the plan. Let's get into it.
Okay, so Intel's Q2 report, it really does feel like a dramatic chapter, doesn't it? They're facing immense pressure.
It does. Let's peel back the layers.
All right, first up, revenue. The headline figure was $12.9 billion for Q2. Intel highlights this as flat year over year. Seems okay on the surface.
Just, okay, yeah. But then you hit the earnings per share, the EPS.
Yes. And that's where things get, well, pretty stark.
Stark is a good word. On a GAAP basis, that's the standard accounting a loss of 67 cents per share. That's significant.
And even non-GAAP, which usually smooths things out a bit.
Still a loss,
Mhm.
10 cents per share, non-GAAP.
Yeah.
So the obvious question is, why? What drove those losses?
What happened there?
Well, this is where it gets really interesting, because the numbers themselves tell a story about deliberate actions.
Right.
Intel was very upfront about the big hits. There was a massive impact, 45 cents per share on that GAAP loss, coming directly from $1.9 billion in restructuring charges.
1.9 billion just for restructuring. That's huge.
Huge. And clearly intentional. They decided to take that hit now.
And that wasn't all, was it?
No, not at all. They also pointed to another 23-cent impact on GAAP EPS
Okay.
and 20 cents on the non-GAAP side. That came from $800 million in impairment charges, plus another $200 million in one-time period costs.
Wow. So you add all that up. It's well over $1 per share just from these specific kind of extraordinary items.
Exactly. Big, big numbers.
So beyond just the hit to the bottom line this quarter, what does it signal when a company takes on so many of these, well, frankly, unexpected charges all at once? Does it mean they didn't see it coming, or is it something else?
That's the key question, isn't it? What's crucial, I think, is that these charges, especially the restructuring and impairments, they weren't actually baked into Intel's original Q2 guidance.
Oh, really? So they were additions.
Yes. Significant additions, which suggests this isn't just, a minor adjustment. It points to a pretty painful, but maybe necessary, strategic pivot.
So less about a lack of foresight, more about ripping the Band-Aid off.
Kind of. It feels like Intel is aggressively trying to shed some legacy burdens, maybe some past decisions to gain future agility. It's costly now, absolutely.
But potentially sets them up better for later.
That's the bet they're making. The big question hanging over it, though, is whether this kind of radical surgery makes them leaner and faster, or does it risk leaving them too thin? Especially when competitors are still investing really broadly.
That's a really critical point.
Yeah.
And we should mention, amidst all these losses and charges, there was one, let's say, glimmer of green.
Ah, yes. Important context.
They did still generate $2.1 billion in cash from operations during the quarter.
Which is vital. It shows that while the accounting picture looks rough because of these big one-time hits, the underlying business is still, generating cash. It's not like the core operations completely stalled.
Good point. So if we zoom out a bit and compare this Q2 to the same quarter last year, Q2 2024, what are the big shifts we see?
Well, the shifts are pretty apparent, and they reinforce this story. Gross margin, for instance. Big drop.
How big?
GAAP gross margin fell from about 35.4% down to 27.5%.
Ouch.
Yeah. And non-GAAP, same trend, from 38.7% down to 29.7%. That's a hefty decline. It could reflect, pricing pressure, maybe a less profitable mix of products being sold.
Okay, so margin squeezed. But what about spending? Operating expenses.
Now that's the other side of the coin. Interestingly, operating expenses, that's your R&D, your marketing, admin costs, MG&A, they were actually down 13% year over year.
13%. That's quite a reduction for a company Intel's size.
It really is, and it tells you that their push for efficiency, the cost-cutting drive, is definitely having an impact.
So even while gross margins are falling, they're clamping down hard on the operational spending side.
Exactly. It's a strong signal of those aggressive cost measures taking hold. You can see the net result clearly too. Non-GAAP net income went from a small profit, about $0.1 billion in Q2 last year, to a loss of $0.4 billion this quarter. So those spending cuts are crucial attempts to, well, stop the bleeding, frankly.
Right. It paints a picture of trying to stabilize the ship financially, which leads us naturally into their strategic response, doesn't it?
It does. The leadership commentary is pretty illuminating here.
What did the CEO Liputan have to say?
He framed it very much in terms of progress. He said, and I'm quoting roughly here, "Our operating performance demonstrates the initial progress we are making to improve our execution and drive greater efficiency."
Okay, so focusing on execution efficiency.
Yes. And he specifically mentioned strengthening the core product portfolio, the AI roadmap that's key, and building a, quote, financially disciplined foundry.
Financially disciplined, that phrase stands out.
It does. And the CFO, David Zinsner, hits the similar notes. He talked about reducing our operating costs, improve our capital efficiency, and monetize non-core assets.
So the message is clear. Tighten the belt, focus, execute.
Pretty much. And it's not just talk. They backed it up with some very tangible and pretty significant actions.
Let's get into those. The headcount reduction seems like the most direct link to those restructuring charges.
Absolutely. The report states they've completed the majority of their planned headcount actions. They've reduced the core workforce by about 15%.
15%, wow.
Yeah. The aim is to end this year with around 75,000 core employees. That $1.9 billion restructuring charge we talked about, a huge chunk of that is severance and related costs for these workforce reductions.
Makes sense financially, but you have to wonder about the impact beyond the numbers. A 15% cut. What does that do to morale inside the company, to institutional knowledge? Their ability to innovate quickly, it's more than just a line item, isn't it?
Oh, definitely not just a line item. Cuts like these are always a double-edged sword. You get the immediate cost savings, you force the organization to become leaner, maybe more focused.
But the risks.
The risks are real. You can lose valuable experience, deep knowledge. You might disrupt key teams working on future products. It really forces management to be incredibly careful and deliberate about where they allocate the remaining talent. It's a tough balancing act.
And it wasn't just people, right? They're also making big moves with their physical footprint, their facilities.
Yes, and this is another really interesting piece, especially regarding capital efficiency. Big changes here.
Like what?
Well, they're pulling the plug on planned major projects in Germany and Poland. Those aren't moving forward now.
Whoa, those were pretty high-profile announcements, weren't they? Especially Germany.
Very high profile. Huge potential investments. So stopping them is a major decision. They're also consolidating some operations assembly and test work from Costa Rica is being moved into larger existing sites in Vietnam and Malaysia.
Okay, consolidation. And anything else?
Yes, they're also slowing the pace of construction at their big new site in Ohio. Not stopping, but slowing it down.
So, pulling back in Europe, consolidating in Asia, slowing down in the US. This feels like more than just trimming fat. It feels like a strategic retreat from some very ambitious global expansion plans.
It certainly looks that way.
While it definitely helps capital efficiency in the short term, you have to ask, what does this mean for their long-term manufacturing capacity and their commitment to diversifying the supply chain geographically, especially when governments everywhere are throwing incentives at chip companies to build locally?
It's a calculated risk, no doubt about it. Is it a smart tactical move to conserve cash now? Or are they potentially giving up future market share or resilience? That's the debate.
And these specific actions, stopping Germany, Poland, the consolidation, are they directly tied to those other charges we saw, the impairments?
Yes, exactly. Intel links these moves directly to that $800 million in impairment charges and the $200 million in one-time costs. Think of impairments as writing down the value of assets that are no longer expected to generate the returns initially planned, like perhaps groundwork already done on a canceled project.
Mhm.
The one-time costs could be things like contract termination fees or other closeout expenses.
Got it. So it's the financial reflection of these strategic decisions to pull back. It shows a clear move to tighten the belt, conserve capital, and focus resources where they expect the best, maybe quickest, return. But it does signal a much more conservative approach to expansion than maybe we expected a year or two ago.
A definite shift in posture, yeah.
Now, this might be a good moment to clarify something for listeners. We keep mentioning GAAP and non-GAAP. Why do companies like Intel present both sets of numbers? It can be confusing.
It can be. The basic idea, as Intel explains it, is that non-GAAP measures are meant to give investors, quote, useful supplemental information.
Supplemental how?
By excluding certain items, things like these big restructuring charges or costs related to acquisitions or stock-based compensation, sometimes items that management argues aren't part of the core day-to-day operating performance.
So the idea is to show the underlying business trend without the noise of these unusual or non-cash items.
That's the argument. It's supposed to make it easier to compare performance from one period to the next by looking at that core performance. But, and this is crucial, GAAP generally accepted accounting principles is still the official standardized way of reporting. It provides the most complete picture, including all those costs and charges. Non-GAAP can be useful context, but you should always look at the GAAP figures too. They tell the full story.
Right, good clarification. Okay, so with that context, let's look at how these broader trends played out within Intel's specific business units in Q2.
Okay, so overall Intel products revenue, that's sort of the main chunk, was down just 1%, coming in at $11.8 billion.
Down slightly. And within that, what about client computing, CCG? That's a PC chip business, right?
Yeah, that's right, desktops and laptops. That was down 3% year over year at $7.9 billion. So still a bit soft there, reflecting maybe the broader PC market.
Okay. But wasn't there some positive news in the segments?
Yes, definitely. And this is a key point. The Data Center and AI Group, DCAI, that segment was actually up 4%, hitting $3.9 billion.
Up 4%. That's significant given how much focus and investment is pouring into AI across the industry right now.
Hugely significant. It suggests Intel is capturing some of that demand, which is critical for their narrative and future growth.
What about the foundry business? Their effort to make chips for other companies?
Also positive, Intel foundry revenue saw a 3% increase, reaching $4.4 billion for the quarter. Again, moving in the right direction for that long-term strategic goal.
And there was one other category? All other.
Yeah, all other. And that actually had a pretty notable jump, up 20% to $1.1 billion. It's a mix of things in there, but that kind of growth suggests some potentially promising smaller bets or adjacent businesses might be gaining traction.
Interesting. So a mixed bag on the segment front, but definitely some great spots, particularly in AI and foundry.
Precisely.
Now, let's pivot slightly to the technology itself. Amidst all this financial restructuring and cost cutting, what's happening on the product and innovation front, especially in that critical AI space?
Yeah, it's crucial they keep the innovation engine running. And one area that really does stand out is their continued push in AI hardware.
What specifically?
Well, they launched new CPUs in their Xeon 6 series. These aren't just general-purpose server chips. They're specifically designed to work alongside GPUs to boost performance for really demanding AI tasks.
Okay, complementing the GPUs.
Exactly. And here's a really interesting nugget. One of these new chips, the Xeon 67766P, actually serves as the host CPU for NVIDIA's DGX B300 systems.
Wait, Intel CPUs inside NVIDIA's flagship AI systems?
That's right. It's significant because it shows Intel Silicon is still a critical component right at the heart of some of the most advanced AI hardware out there. Even as NVIDIA dominates the AI GPU space, Intel is playing a key role in the overall system. It's a direct connection. Intel Silicon enabling cutting-edge AI.
That is a strong statement about their relevance in the AI ecosystem, even if it's not always the headline component. What else is cooking on the product side?
Well, looking ahead, they say the first chip based on their next-gen Panther Lake architecture is still on track to ship later this year,
Okay.
with more variations coming in the first half of 2026. So the pipeline for client processors seems to be progressing.
And manufacturing. That's always key for Intel, especially with their foundry ambitions.
Absolutely critical. And they hit a milestone there, too. They announced that Intel 18A, that's their really advanced next-generation process node, sort of equivalent to what TSMC calls 2 nanometers or below. They started running the first production wafers using 18A in their Arizona fabs.
Starting production wafers. That's a big step, right? Moving from development to actual manufacturing.
It's a huge step. It's essential for proving the technology works at scale, which is vital both for their own products and for convincing potential foundry customers that they can deliver on their promises. It's key to competing at the leading edge.
So progress on AI enablement, next-gen client chips, and a key manufacturing milestone. Seems like the R&D side is still pushing forward despite the financial pressures.
They have to. Innovation is non-negotiable in this industry.
And one more financial move we should mention, they also did something to strengthen the balance sheet further, right? With Mobileye.
Yes, that's right. In July, just after the quarter ended, they sold a block of Mobileye shares, 57.5 million Class A shares.
Mobileye, their self-driving tech company.
Exactly. That sale brought in about $922 million in cash. Important to note, though, Intel still remains the majority shareholder in Mobileye. They emphasize they still believe in its long-term growth, so this seems more like a, tactical move to raise some cash rather than a strategic exit.
Okay, makes sense. So, putting all this together, the Q2 results, the restructuring, the product progress, what does Intel see looking ahead? What's their guidance for the current quarter, Q3?
Their Q3 forecast gives us a window into their near-term expectations. They're projecting revenue in a range of $12.6 billion to $13.6 billion. So potentially slightly better than Q2 at the midpoint.
And the bottom line, EPS.
Still expecting a GAAP loss, forecasted at 24 cents per share. But interestingly, they're guiding for non-GAAP EPS of basically $0.
Break even on a non-GAAP basis.
Essentially, yes, which would be an improvement from the Q2 non-GAAP loss. And they also expect their non-GAAP gross margin to tick back up a bit at 36.0%.
So the guidance suggests maybe some stabilization, perhaps the beginning of a recovery, at least on that non-GAAP operational level.
That seems to be the hope, yes. Slow improvement.
And zooming out again, what about the longer-term targets they've set? Do those still hold?
They reiterated their commitment to those longer-term efficiency goals. They're still targeting $17 billion in non-GAAP operating expenses for this full year, 2025.
Okay.
And they're aiming for an even leaner $16 billion in 2026. So that cost discipline message is very consistent.
And capital spending, after cutting back on those big projects.
They're still planning significant investment, just maybe more focused. They anticipate $18 billion in gross capital expenditures for 2025. So still investing heavily, but perhaps more carefully than before. It really underscores this disciplined strategy: manage costs tightly, invest selectively.
But that kind of aggressive cost-cutting, especially in an industry like semiconductors that thrives on massive, sometimes risky long-term bets, it does come with risks, doesn't it?
Absolutely, and this brings up the broader picture, the context surrounding these results.
Right, the headwinds they're facing.
Exactly. Intel's own report in the forward-looking statement section lays out the challenges pretty clearly. It's not just about internal execution.
What do they highlight?
Well, intense competition, obviously. Rapid technological change, you had to keep pace. The fact that they're making these huge long-term investments that are inherently risky. Complex global supply chains, which we've all seen, can be disrupted.
Sure.
Then there are the macroeconomic conditions, inflation, interest rates, potential recession fears, and crucially, geopolitics.
That seems unavoidable these days.
Right. They specifically mention tensions involving U.S.-China, the ongoing war in Ukraine, the situation in the Middle East, and the China-Taiwan relationship, which is obviously critical for the entire semiconductor world. Plus, the rapidly evolving market for AI itself, how demand shifts, who the winners and losers will be.
So it's not just about getting their own house in order. They're navigating a pretty turbulent external environment as well.
A very turbulent environment. These aren't minor issues. They're fundamental challenges that require incredible strategic agility.
Okay, so let's try to wrap this up. To recap, Intel's Q2 results showed a significant GAAP loss, heavily driven by those large, deliberate restructuring and impairment charges.
Yes, the company taking some pain now for future gain. That's the narrative.
But beneath that, we see a company that is aggressively reshaping itself, focusing intensely on efficiency, on cost control, on its core products, and very importantly, on its AI roadmap.
And there were some positive signs in the business segments, particularly data center and AI and foundry revenue growth.
Right. So for you, the listener, maybe the takeaway is to think about what these moves really signify beyond Intel's own financials.
Yeah, like how does Intel pulling back from big projects in Europe impact those local economies, or the global push for supply chain diversification?
Or what does this intense focus on being a financially disciplined foundry actually mean for chip prices and availability down the road, especially with AI driving huge demand? Does discipline mean more expensive or just more focused?
Good questions. Intel is clearly making some tough, very costly decisions right now, betting that it will lead to a leaner, more agile, more profitable company.
But the lingering question, the provocative thought maybe, is this. In this incredibly fast-moving tech landscape, dominated by AI breakthroughs and fraught with geopolitical uncertainty,
Right.
will these cuts, this consolidation, this focus on efficiency truly be enough? Will it let them outmaneuver competitors who might still be spending more broadly, or could this belt-tightening actually create new weaknesses down the line?
What's the hidden cost, perhaps, of prioritizing greater efficiency today in an industry where bold, maybe even seemingly inefficient long-term investment has often been the key to winning tomorrow?
Something to definitely keep an eye on and ponder.